Well, look, the recovery of markets has been impressive indeed. But I think we should keep a clear view of what is driving asset prices at what time horizon. And we know liquidity plays a crucial role in determining the equilibrium level of equity prices in particular. So we have fixed income markets that have essentially been from now on administered by policymakers. We've seen the range of measures taken by the US Fed that encompasses investment-grade corporate bonds and to a certain extent below investment-grade bonds of the highest quality. And we have an unprecedented transmission of liquidity in the system simply because this recession is of unprecedented nature. What I mean by that is that the typical recession happens when at the end of an expansion cycle, the central bank tightens, and the lag effect of liquidity tightening is still playing out as the economy contracts. This time is radically different in the sense that as the economy was expanding, we were still in loosening phases of monetary policy in both the US and China and actually as well Europe. Therefore, we went into this recession driven by an external shock, the pandemic. We went into it with easing liquidity conditions. Then the moment the administrative measures to contain the spread of the virus were taken by governments, we had an immediate additional tsunami of stimulus, both on the monetary and fiscal side. I'm sure we'll talk about that. And so liquidity is transmitting very rapidly to asset prices. But actually, if you look at the S&P 500, I would argue, and that's very counterintuitive, at 3,100, the S&P 500 still prices recession. Why? Because our favorite measure of implicit expectation in equity prices is not the absolute level of the index, but an underlying measure of how cheap stocks are relative to expensive stocks, intra-sector valuation spreads. They were at record high by end of March, early April. They've come in recent weeks with the catch-up of value cyclical names. We've seen some recovery in energy stocks, financials, etc. But the spread remains today, as we speak, at recessionary levels. Right. So the market under the surface does not indicate yet a successful reflation by policymakers, even though recent announcements in Europe have certainly exceeded expectations.